We'll get to our Mike Santoli. Good morning, Mike.
Good morning, David. Yeah, I mean, we have this low drama ratcheting higher of the S&P 500. It seems a lot like those periods of time we called melt-ups in the last several years, really raising the question as to what's getting priced in here. I think we're somewhere between pricing in plausible progress and perfection. So one way to think about it, rule of thumb-wise, if you get to S&P 4,000, a lot of upside targets technically get you to 4,000, less than 3% up from here. You're at 20 times the consensus for 2022 S&P 500 earnings. So you're 20 years a year ahead of it. The year doesn't even start for 11 months. So yes, getting a little bit stretched. I think the key, though, is that little shakeout we had really did reset expectations. It knocked loose a lot of cash. It maybe rebuilt the wall of worry a little bit, and we're benefiting from that because the credit markets held together really well. Optimism, very understandably, has now become consensus because of all the early recovery forces, the fact that we have fiscal stimulus coming, and the profit outlook looks really good. I say valuations getting stretched, but it's on a year-ahead basis. Stable since May because earnings forecasts are up so much. So finally, the silly stuff a lot of us are watching, whether it's 350 SPACs out there, whether it is some of the meme stocks that get rolling, it's there. It looks frothy, but that stuff can kind of roll for a long period of time. And we both have seen that, obviously. And I think that that's what we have to be careful about, looking at those things and saying, aha, that must be the sign that some kind of a top is in right here.
Yeah, but Mike, you point out 20 times 22.
Yes.
I can hear all the strategists that we'll bring on or the investors saying, yeah, but look at the interest rate environment. Of course, that's certainly justified given where we are, although rates are starting to move up a little bit. And I do notice the banks have a lot of life to them.
That's absolutely right. So the question is, where's that equilibrium in terms of what yields can do on the upside and whether that, in fact, can continue to have people at least explain away high valuations, whether or not it justifies it. I think one way of looking at it, and a lot of Wall Street does this, is looks at that earnings yield relative to the Treasury yield. It's basically as low as it's been in a few years now. So in other words, you're losing that cushion a little bit as rates go higher, though, of course, we'll see if there's any moderation in that Treasury yield move because a lot of people are short Treasuries right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.